It's okay? That's much better. Thank you. So I was saying the workshop today is about why we are convinced that the liquid alternative investment industry is destined to grow in Europe and especially in Paris, and why we believe it's a necessity for a sustainable autonomy. But first, let's define what we mean by liquid alternative investment. It covers uncorrelated absolute return investment strategies through liquid assets by opposition to illiquid assets, such as private equity or private debt. These strategies are typically investable via offshore hedge funds with monthly and quarterly liquidity, and for some strategies via daily and weekly usage. But let me first introduce our panel. So we have Jessica OLESON, who is head of Subadvisory partnerships at Bridgewater. Thank you, Jessica. We have Nathanaël BENZAKEN as well, next to me, head of alternatives at Amundi. We have Emmanuel Gavaudan over there, founder and CEO of Boussard and Gavaudan. And we have as well Nicolas GAUSSEL, coming from Paris, funding partner and CEO of Metori Capital Management. Could I ask you, each of you, to present your firm and a quick word on the strategy of the firm, please? Perhaps Jessica first.
Sure. So thanks, everyone, for coming. And I'm happy to be here in Paris, all the way from Westport, Connecticut. Bridgewater, which some of you may have heard of or know something about, was founded almost 50 years ago now. And our goal has always been to provide diversification, risk management to institutional clients. So historically, our partnerships have always been with institutional clients by understanding what drives markets, what causes prices to move, and then implementing that in a disciplined way through time. So our primary business today is building portfolios, but we actually got our start, which may be a surprise to some of you, as an advisory firm. So we advise companies on how to manage their financial risks. And one of the panelists earlier today was talking about how to be an alternatives manager, you have to think about risk management. And I think that couldn't be more core to our philosophy at Bridgewater, that really we are a risk manager before we are anything else. Perhaps the most important way to manage risk, in our opinion, is by understanding. Some of you may be familiar with our daily observations, which are our way of articulating our understanding. We send those to our clients, and sometimes they make their way into the press or other places. But that is, I think, core to who we are. And one last comment I'll make is, when I joined Bridgewater just after I interviewed during the 2008 financial crisis. So we're all thinking of the most recent crises that we've been through, but 2008 was another time. And I think that story, to me, is emblematic of who Bridgewater is, because I interviewed through the course of fall 2008. 5 days before Lehman failed, I had my first interview. I figured that would be the end of the interview process, but interviewing with Bridgewater was like nothing was going on. It was stable as she goes. The returns in 2008 were right on target, and it convinced me that combined with the quality of research I saw was the kind of firm I wanted to be associated with. And anyway, that's how we approach our business, is managing risk, managing through crisis, providing diversification in the times that people need it most.
Thank you, Jessica. Nathanaël?
Well, good afternoon, and thank you for being here. So I have the pleasure to represent Amundi today. I don't think Amundi doesn't need to be introduced and presented. It's one of the largest asset managers, global, diversified. What is probably more relevant is that through the merger with Lyxor Asset Management, which I'm coming from, I have the pleasure to lead a brand new business line called Amundi Alternatives, which mandate is to essentially expand our offering in liquid alternatives, which is effectively hedge funds, as opposed to what some called illiquid alternatives. We've been in that business for over 24 years at Lyxor, pretty much based on the same premises as Bridgewater, as we got created by SocGen to get exposure to our clients to hedge funds in a secure environment, secure defined by essentially protected from misappropriation of assets, fraud, simply put, but also to avoid any extreme risk through what we call managed accounts, which is a concept which gives us ownership of assets and transparencies, and therefore we are able to monitor the trading activity by the manager. So therefore, we're getting the best of them and avoid what's sometimes extreme risks. We've evolved from that over the years to become essentially one of the largest UCITS platform. We run in excess of 8 billion right now, and we obviously have great ambition to expand with some sort of a vision to bring hedge funds into Europe through the UCITS label.
Thank you. Emmanuel?
Good afternoon. My name is Emmanuel Gavaudan, and our firm, Boussard and Gavaudan, was created 20 years ago by my partner Emmanuel, Boussard, and myself. We used to work together at Goldman. Today we have a fund that is about 3 billion with 3 billion assets. We have offices in London, Paris, which is our largest office today, and New York, where we have a small operation. We are very focused on what the prop desk of Goldman was doing 20 years ago. We're doing mostly arbitrage of convertible bonds, hybrid instruments, volatility, cap structure arbitrage, risk arbitrage, and special situations. So we are very micro. I think most of the other panelists here are more macro in nature. So we're looking at corporates. We investigate the balance sheet. We are catalyst analysts. We are looking for catalysts in all the operations we are looking at. And one way to look at the business we are running is to see that our goal is to bring assets and the type of liquidity and risk money that the corporates need at certain times. So, if you go through the investment cycle, at some points, corporates will need high yields. They will need convertible bonds. They will do rights issues, and will be there for all of these instruments. And then through bull markets, they will need financing, either straight financing or through hybrid instruments like mandatory convertible bonds. Our goal is to bring the type of capital that is needed to the different corporates at the time where they need it. And thank you.
Thank you. And Nicolas, perhaps to finish the introduction.
Yeah. So good afternoon, everybody. Thank you for being here. My name is Nicolas GAUSSEL, and I'm the co-founder and CEO of Metori Capital Management, which is a hedge fund, Paris-based company, which we created back in 2017. So Metori is specialized in quantitative management, so it's a systematic macro, if you wish. We run about 800 million euro to date, with a headquarters in Paris, offices in Princeton and Zhuhai in China. So in terms of investment thesis, or what kind of value we try to bring to investors, first, we play in the liquid fields. So we want the money to be liquid. And second, we want to help investors bringing diversification to their portfolios. Diversification meaning a stream of returns which is different from equities. And this is where the difficulty starts, because when you diversify, you need to go in areas you don't really understand or you don't know. And you have to have, I would say, a help or understanding of how to kind of assess the risk-adjusted return on those markets you want to invest in. So our role is to do that. We do that by investing into futures market and in, I would say, all class type of asset class, equities, bonds, short-term rates, commodities for some mandates. And so this is basically what we do.
Thank you. So impressive panelists, as you could see. Since we have a very diverse audience today, I thought we could start with a bit of history on the industry. So perhaps, Jessica, you can give your view on the US in the last decades, hedge fund industry.
Sure.
Thank you.
One of the things about Bridgewater that I think might become obvious through my comments is that we don't necessarily think of ourselves as a hedge fund. We never did historically. We've been tagged the world's largest hedge fund and those types of things, but the way we always thought about the world was our job was to manage risk and to generate returns. And the best way we always thought to do that, I will get to your question, the best way we always thought to do that was by having a diversified portfolio. So as all the different asset classes, all the different liquid asset classes that we can trade, and put together the best portfolio of all our best ideas in one place. And what we've seen in terms of trends, I think, is more and more of a recognition that alternatives are helpful to a portfolio, but only if you choose the right alternatives, if you choose the right manager. And some of the aspects that we've looked at, we've actually published quite a good deal of research on why you don't want to invest in certain funds for certain reasons, which in our opinion boils down to either a concentration or a bias to perform like equity markets or like any of the public markets you can invest in for free. And what we've seen is a bit of a consolidation in the industry in the US, where there is a flight away from more of the fund-of-fund model and sort of picking lots of different hedge fund managers, a flight more to quality of hedge funds. We ourselves haven't had outflows. We've been closed in our strategies for most of the last over a decade now. But we have seen, sort of a consolidation and people trying to move to quality among hedge funds. But importantly, even after 2008, most of the partners that we work with in the United States did not get rid of their hedge fund bucket, as they call it, or their alternatives bucket, and maintain that exposure to alternatives, which different times over the last decade has paid off less or more, but certainly this year has been a big benefit. In our flagship alpha strategy, we're up about 27% this year, and that's one example. We don't always get it right, but when we do, it can be very beneficial to the portfolio. So I think that's probably the biggest trend that I've seen.
Thank you. Nat, maybe for the Europe, what's your view on this hedge fund history over the few decades?
I think I would share pretty much the same story as Jessica, as the industry is fairly young. If you look back from a time perspective. I think the main and most important event in the industry has been the AFMD in 2011, if I'm mistaken, which essentially started to pivot the industry from essentially being able to distribute offshore funds in Europe and essentially preventing that from happening. And there was some sort of a transition period, give or take, which makes it today a market essentially very hard to sell pure hedge funds, old-fashioned hedge funds in Europe. The beauty of that AFMD essentially timing was that it triggered a new way to do hedge funds. We thought in 2011 that it was AIFM, the AIF format, let's say the offshore version into onshore. The market dictated otherwise and embraced the UCITS format to essentially deploy capital into so-called liquid strategies. So as you probably know, UCITS is great, it's well known, it's growing. As a matter of fact, I think there's a shortage of good product and a shortage of capacity. This is also why we have such a title of the event, and we believe the industry is destined to grow. But clearly, the industry has slowly embraced that. I think we have had at OLESON and Amundi, we have done a great deal of job explaining, educating non-European managers why UCITS make sense, why you cannot sell what you do offshore into onshore, and therefore you have here a format, a tool, a technology, which is quite topical these days, to essentially encapsulate a hedge fund strategy in a way that is or can be fairly similar to what you do offshore, as long as it's liquid. I think we can debate that later, into a format that is freely available and marketable into Europe. And I think this is where we can see potentially a revolution of giving access to hedge funds to investors who couldn't access hedge funds beforehand. And again, to my credo that there aren't enough managers out there in UCITS, there aren't enough capacity out there. As you know, the good hedge funds tend to be capacity limited. And therefore, again, at Amundi Alternatives, what we want to do is to expand that universe. We may actually embrace the AIF format for less liquid strategy. Eventually, I think there will be a market so that we can map out from liquid to less liquid. And I think 2022 in itself can also be a catalyst for this acceleration, in a sense that if you look at what happened out there in the market, obviously all indices, equity and fixed income, have crashed big time. And as far as I saw today, it's not finished. The industry, on average, and on average in a sentence is very important, has done well. I mean, if I look all the indices I've seen, global UCITS, it's kind of flat year to date, but it's obviously hiding a wide dispersion within managers, within strategies. If you take the macro space, I think, and Bridgewater, I guess, you are a great evidence of that. It's been a fantastic year for such strategies. Same for CTAs, plenty of trends, long and shorts. Long-short equity managers have done well on average also with a decent dispersion, which comes to what Jessica said. I think there is a great opportunity for investors to start building a portfolio if you believe that we have shifted from one paradigm to another, which is where prices of equities are high and they will be volatile. Interest rates are on the rise. You could talk about corporate risk, credit risk, and so on and so forth. If the environment is not going up on the equity side, down on interest rate any longer, if you believe that, then the 60-40 model, which we used to use as a reference, should be changed a little bit, challenged a little bit, and suddenly adapted with adding a bucket, that's the word you use, I guess, a bucket of hedge funds to help diversify the traditional risky assets. So the future is bright. It's a matter of having more product, more education, why it makes sense in a portfolio. So stay tuned. I mean, this is something that we want to participate actively in.
Great, thanks. Really to link to the hedge fund industry purpose, because we touched base on that already, the performance. And I'd like Nicolas to have your view on that. So what's, in your opinion, is hedge fund ensuring long-term performance for investor savings, and how come, and what's your view on that?
So this is obviously a key question, which is where does performance come from? So the bulk of the origin of performance is the work of companies and possibly the financing of states. So I would say this is the bulk of the offer of performance. And this is why the bulk of the savings are invested into equity and bonds. But having said that, you have other things to do. And when I was a CIO at Lixor, I was always wondering on which ground can I build a safe asset allocation as a fiduciary to long-term investors. We have a responsibility, and I found it extremely difficult to base it just on expectation, because expectations, they vary in time, and they are ill, I would say, grounded. And so you have to find things that are stable in time and kind of differentiate what is stable and what is not. And in other terms, you could call that a strategy. This is what corporates do, and this is also what investors should do. So you have an approach which is seeing investment as a series of opportunities, which obviously is part of the investment world. And you have another approach, which is to identify a strategy for the coming 20, 40 years. In France, typically, we have to save during 43 years, which is a time where we work. So we put our salaries, sometimes it's intermediated by the state, sometimes it's not, but you have to put that money and you expect that at the end of your life, you have either a lump sum or a series of payment, which is your retirement. If you run a very simple computation, just 1.6% difference in performance makes that your retirement is multiplied by 2 or divided by 2 during 43 years. Okay? So you feel the weight of your responsibility as a money manager, because yes, you have a series of responsibility as a citizen, you have many responsibilities, but this responsibility of having the retirement at the right level for, I would say, investors is a heavy one. And so this is really why, having this in mind, we try to find those elements in the market which are stable. And if I look at our own strategy, this is basically, you can see it as a trend following across a various set of markets. If you look at the SG Trend Index, which is a representative of the performance of this industry, if you start in 2000 and you end up now, it has performed better than the S&P 500. It's just a fact. I don't know how many people are aware of it. And the correlation between that SG trend index with the S&P 500 is basically 0. So yes, you're right, you need to identify the right manager, but you have some strategies which as an industry generate returns. So we propose a version of that trend following engine, which we feel is at least as good as our peers, but the engine is here. And what we try to kind of convince, or we try to kind of document this investment thesis, which is when you are a long-term investor, this makes a lot of sense. And of course, after I can elaborate for hours, but the very important thing about that very strategy is that it's not only an investment strategy, but another way to put it is that it's a risk management strategy, because you permanently assess the risk and return balance across a very large investment universe. And at the end of the day, you end up with those, I would say, nice sharp ratios, but maybe even more importantly, drawdowns which are controlled, and I would say a true liquidity.
Thank you, that's very clear. But apart from the performance, there's another key role of hedge fund in our financial ecosystem, and I'd like Emmanuel to comment on that. In good times, so banks, including SocGen, regularly use hedge fund to hedge exotic books in order to support their activities with clients, but also in difficult times to ensure market continuity in times where markets are dislocating. Hedge funds are the ultimate risk takers. Emmanuel, I know Boussard and Gavaudan has played a key role in that in 2008 and 2020. Could you elaborate on that, please?
Yes, thank you. So the role of hedge funds in the market is actually quite important and pretty much underplayed very often. But I think today we could dwell on two specific moments where I think hedge funds have played a very important role and a critical role in kickstarting a virtuous circle of financing for corporates at times where the markets were in the darkest point. So the first one you alluded to was March 2009. So just a few months after the bankruptcy of Lehman Brothers, when most of the markets around the world were hitting new lows and the bottom of their cycle, the markets were closed. So, you know, corporates on a daily basis, they need to finance themselves. They need cash for their operations, for their treasury, for expansion, for capex, etc. But the markets were closed. They just could not raise any cash anywhere. And it just happened that at that point, one of the corporates that was probably in a more desperate situation than the others, but at the same time in the strong position that they were able to go to the markets, came, and it was ArcelorMittal that reopened the market with a hybrid instrument, which is typically an instrument which at that time was bought by mostly hedge funds, who were able not to and the reason they could do it is that they were not playing the directionality of the stock, like most of the long-onlys would do, but they were playing the volatility implied in the hybrid instrument. And by hedging themselves, they were able to provide what turned out to be a great success and the kickstart for the virtuous circle of refinancing. The market had been closed. Nothing had been raised for over 6 months. And in the space of just a few weeks, you had 19 issues for 11 billion done just in Europe. Actually, 5 billion out of the 11 were French companies, you know, like Peugeot, Air Liquide, you know, Morel & Prom, etc. And hedge funds like ours, you know, were able to commit, you know, 100, 200 million in some of these deals and truly help the company to finance themselves at times where everything else was not working, especially the straight bond market. So that I think is a moment, and I think this issuance of ArcelorMittal, which was followed just a few days later by Anglo-American in the UK, truly reopened the market and gave the start of the bull market. It was the canary singing, but actually a good song in some ways by restarting the market. So that's the first point. And that role cannot be underestimated by the market or even the players. Now, the second moment, which is fairly similar, although more brief, obviously, was the COVID crisis in March 2020. So it's a more recent moment. But at that time, a huge amount of corporates around the world and in Europe, whether they were working in cyclical industries or hotels, tourism, travel, you name it, a lot of these corporates had no idea how long it would be. And many of them, scared, wanted to strengthen their balance sheet. The straight bond market was closed. Financing around the world was closed as well. And here again, in Europe, it started with, on the 1st of April, so really right after just a few days after the rock bottom of the market, it started with a company in the Eurostock 50, Amadeus, which is software for airline companies. And it's a great company, but they needed to strengthen their balance sheet out of cautiousness. And they came with a 750 million convertible bond, where there was almost no demand from long onlys in that paper. I mean, basically almost none. And yet that market is controlled 80% plus by long onlys. But in order to buy that paper, you needed to have a view on the directionality of the stock, which was pretty dim at that point. Hedge funds like ours, were able to actually take a lion's share in this issuance, over 100 million, by delta hedging that paper, being able to provide the liquidity needed at the right time by the corporate and help kickstart in exactly the same way between the 1st of April 2020 and in the next 3 months, you had 11 billion again raised by all sorts of corporates from all kinds of industries needed to strengthen their balance sheet. And the bulk of this issuance was taken by hedge funds who were delta hedging and playing the vol component into these papers. So, here again, I think it's quite important to see that role cannot be underestimated because it did mark, in both cases, the bottom of the market and helped greatly the corporates to ensure the fact that their operations were going on. And so I think these two examples are critical, but we don't only work with corporates, and I think there's also the view that sometimes hedge funds are at odds with regulators, and I think it's also the wrong idea. And I would like to develop here briefly an idea and a fact that post-08, post the Great Crisis, what happened is that we all realized that the banking system was too weak for its own good, and the regulators around the world rushed from Basel II to Basel III and asked the markets to come up with loss-absorbing papers. So loss-absorbing papers was something new at that time, and it was the creation of the additional tier 1. The additional tier 1 was by and far initially created with the help of hedge funds that were committing lots of money in papers that could not be bought by the equity players or the bond players. I remember going across Europe and the US, most credit funds in their bylaws or in their prospectus or in their covenants were prevented from buying papers that could be converted into equity. And therefore, the task of providing risk money was almost entirely initially in the hands of hedge funds who had the flexibility, who were nimble, who were able to embrace change and creation in these papers. Now today, it's a 200 billion market. So it's about 3 times, just to give you a sense, it's about 3 times the size of the entire convertible bond market in Europe. So this is not an insignificant market. It plays a huge role to strengthen the bank. it played into the hands of the regulators, who were very happy to see that the banks were strengthening their balance sheet with the additional Tier 1. But once again, the help of the hedge funds to kickstart that new asset class and provide the banks with the right capital at the right time was critical. So I'm sorry, it was a long answer to your question, but I just wanted to focus on just 3 examples. If you want more, I can give you extra.
That's perfect. Thank you. Very clear. And there's a lot of responsibility in your answer, and I'd like to talk about ESG now, because it's a big day today about sustainability. So that's as well something we want to talk about for the hedge fund industry. You may think, hedge fund, ESG, what the link there, but there's a strong link, you'll see. Jessica, could you elaborate on the various ways?
Sure.
Thank you.
Yes, thank you. So sustainability has become a very important topic for us at Bridgewater. I think it's been an important topic in this country for much longer than it has for many investors in the US. But increasingly, what we've been seeing from investors is a demand to consider not just 2 dimensions, the 2 dimensions, traditional dimensions of risk and return that I've focused on in my previous comments, but a 3rd dimension, which is, you can call it ESG, you could call it sustainability. We refer to it as sustainability. But we've seen an increased demand for strategies that address that topic. Now, when we looked out there to see what do people do in sustainability, we were already doing our own research to understand how factors related to the environment or social factors or governance affected the investments that we were making. We were already incorporating that into our systems, but then on top of that, we recognized that there are basically by and large, 2 approaches to investing sustainably. One is you exclude the companies or the names or the securities that are most disadvantageous to the goal of sustainability. The other is you invest in the ones that are likely to have impact towards a sustainable future. And that's the path we decided to take. So I alluded a little bit to our fundamental process where we try to understand what drives prices. We implement that systematically. We took the same approach and translated it over to sustainability. So we've launched a sustainability business, really. We've appointed 2 of our senior investors to be co-CIOs of that, and we are making a dedicated effort. So while we continue to factor in sustainability factors into our traditional investments in the way of just understanding how do those elements affect the investments we're going to make, in our sustainability business, we're only investing in securities, companies that will have impact toward the goals of sustainability. We'll go into a lot more depth, but that's how we're approaching it.
Thank you. Perhaps, Nicolas, you want as well to say a word. Your approach is slightly different, but very complementary as well.
Yes, indeed. So sustainability is something we are all very much concerned about. And our approach was trying to be, or could I say, to kind of tie up the difficulty of sustainability. But there is one temptation, which is to run, I would say, with maybe the crowd or I don't know whom, and say, okay, I want to remove this or that and this. And just by doing that, you don't really understand what you do and what the consequence on the long run. And so you try to tie up the real difficulty, which is obviously to measure sustainability and to measure the impact on long-term performance. And so we started with building a reporting on ESG. So you have to report on your investment universe. And maybe the slight difference between hedge fund and I would say mutual fund industry is that we use a toolbox which is maybe a little more diverse. And by that I mean we use long, short derivatives. And in the ESG world, there is a lot, I would say, of which has been done on rating companies and states, but less to rate derivatives on company, derivative on states. And a very simple example is that you know what it is to lend money to, let's say, Germany, you buy a bond, but what is it to borrow money from Germany by being short a future on the Bund? And so this long-short issue, which appears as something terribly difficult in the equity space, it's just all natural in the fixed income world, and even more natural in the FX world. Because being long, let's say, I would say an interesting position those days, long USD, short Nikkei. Is it better than being long Nikkei, short USD? Is one position good and the other bad? Obviously not. So you need to be in a position to assess both the risk of a long and the risk of a short strategy. And then you need to be able to aggregate those notation across different asset classes. Because at the end of the day, if you want to be serious for investors at the end of the day, which is our role, you need to assess the sustainability, I would say, note or score of the entire portfolio. And then after, imagine you have a measure of sustainability, which is what we've put together for our portfolio. You can now measure, okay, let's say I want to be more stringent of the measure. I want more sustainability. What's the impact of my, in terms of long-term Sharpe ratio? Because there has to be one. You can believe that because of flows or for some kind of magic reason, being sustainable will bring returns, but obviously it just can't be a dream. At the end of the day, there might be period where being, I would say, virtuous in terms of ESG will bring returns. Probably it was the case until, I would say, the Ukraine crisis. But more recently, I mean, the geopolitical story blows to our, I would say, views, and you see that it's not that simple, that commodities, energy, carbon energies, they went to the roof, agricultural commodities as well. All those players which have benefited from those trends have outperformed. Those companies which are in the, I would say, military complex, I have in mind the Lockheed Martin of the world and the like, they have outperformed their peers for some obvious reason. So now starts the interesting discussion, which is where do you want to put, I would say, the trade-off between ESG and long-term returns, and this is the way we handle it.
Thank you. Back to our initial question, so why are liquid investment strategy destined to grow? I'd like to have to take views on the panel about this very important question, which is why in the global market today, why there's a growing demand on agile strategies and uncorrelated solutions as well. So comparing passive versus active, comparing liquid versus illiquid, typically. Perhaps, Nat, you could start.
Sure. As I said, I think we have shifted from one decade paradigm to a new one. At least we believe so. And therefore, you have to determine how you want to diversify your long-term equity, fixed income, credit book. Of the last few years, we have all read these buying spree into illiquid alternatives, and I think they've done the job, private equity, real estate, and so on. The question that investors should ask themselves today is, if you buy into this concept of pivoting from one paradigm to the other, or maybe in other terms being at the top of a cycle, then you want to build alongside your illiquid alternatives. You want to consider liquid alternatives, which gives you not only ability to diversify, hopefully if you do the right manager selection to get alpha on top of your stream of betas, but also give you the agility, the nimbleness to be able to adjust your portfolio as the environment evolves, as war evolves, comes in, comes out, hopefully come out soon. In an environment that is really unpredictable, like any environment, but here we are at the peak of a cycle with many new driving force that are essentially changing direction fairly brutally. So another, I mean, if you buy into this, then you may want to say that maybe what happened in the US and Canada, as a matter of fact, a few years back may well arrive here in Europe. The hedge fund it's not an asset class, but it's a set of active strategies that have been adapted long time ago in big pensions as a way to diversify and manage drawdowns and generate a stream of alphas. If you believe in this post-AIFMD, AIF, UCITS routes as being credible, then there's a tool here available for the European investors, the wealth managers, the private banks, but also ultimately the institutional investors to essentially embrace that and adjust their strategic asset allocation down the road. And therefore, if you look at the mass of AUM, if the industry, I believe, adds up to $4.3 trillion of AUM in total, only 300 billion is in UCITS. And this is simply the reflection of the amount of capital invested in the Americas, a little bit in Switzerland, Middle East, and a little bit in Japan. The rest needs essentially a European onshore format, mostly. And therefore, we might see that trend. We might see investors and managers. I mean, 2/3 of the managers are in the Americas, in the US, as a matter of fact. And this is what we've been doing, actually, trying to convince them to say, okay, well, UCITS, AIF are very legit vehicle solution to essentially crack into Europe. That is happening. We see the trend. It will accelerate at the minute. Strategic asset allocation of investors will change to reflect this change in paradigm.
Thank you. Perhaps, Emmanuel, you want to elaborate as well on the liquid and illiquid approach of hedge fund?
Well, yes. So, you know, we are sitting very much at the liquid part of the hedge fund space for reasons I explained earlier. You know, for the you know, to jive with what you were saying, you know, we are an Irish AIF, and we did the change over a decade ago because we thought that that was the route for the future. We believe that Cayman and Cayman-based funds are problematic in many different ways, starting from governance to regulatory environment, etc. So we believe that you know, for European hedge funds at least, you know, being based in onshore Europe is actually quite important and critical. So I very much agree with what Nathanaël was saying, and I think in the same way you've had a huge rise of demand for very liquid assets, you know, especially in the last 5 to 10 years with the rise of private equity. I think in time of crisis, people are very happy to have some liquid alternative that protect them against market downdrafts, as we've seen, but more importantly with liquidities when sometimes cash calls are coming from their long-term investment in private equity. So I think it's a matter of balancing your portfolio and the way you allocate your money across the time spectrum, and I believe that both from a liquidity standpoint and a regulatory standpoint, I think hedge funds based in onshore Europe, whether they are QIF or SICAVs, play a very important role in pension funds portfolio, in states portfolios, in family offices, trusts and foundations alike. And we see all kind of different characters investing in these funds for these reasons.
Thank you. Nicolas, if you could say a word on the future of the hedge fund industry, in your opinion? And maybe some of you want to comment on the fact that we have as well big hedge fund with large hub of hedge fund managers and sort of consolidation of the industry as well that we see in the last few years. That could be interesting. Maybe Nat later.
So it's difficult to have a kind of prediction, but what we can just see today is the surprising difference in hedge fund allocation when you compare the institutional allocation to hedge fund, the institutional allocation to hedge fund in Europe, for instance, it's around 9 to 10%. In the US, it's more around 15 to 20%. And in France, it's close to 4%. So it's puzzling because theoretically at least, investors looking after long-term performance should have basically the same allocation. I mean, you have the domestic bias, you have some local and cultural biases, but apart from biases, what could be the reason why an ideal portfolio on that part of the Atlantic Ocean is no longer an ideal portfolio on the other part of the Atlantic Ocean? Who's wrong in some way? So it's difficult to assess. If you look at the figures and at the long-term returns and simulation, in my view, there is the 4% allocated to liquid alts by French, because we're in France, institution is too low. It's suboptimal, basically. It's definitely, I've played around with that figures for more than 15 years, and I still don't really catch it. My view, obviously, is that people are rational, so there should be a good reason for this, but I still don't understand why. Because at the end of the day, and specifically, I don't want to do some kind of publicity for Amundi platform, but specifically, you have you can perfectly understand that investors cannot kind of swallow things which are too far from their culture or too far from what they can understand and risk manage. This is perfectly understandable, and precisely we are very reluctant on our hand to propose our own funds to retail. I knew for years like 2022, I have many friends, so we are doing very well. Many friends coming to me, can we invest in your funds? And I just don't like that. Go through your private bank, and this is not our business, it's a different business. So you have people who are doing that job to kind of put together the different investment and provide the environment of information, transparency, risk management, and with that backdrop, there should be more investment in the liquid investment space. At least in my view.
Thank you. Jessica, you may want to elaborate because you see both sides of the Atlantic Ocean, so being based in the US, but as well, marketing a lot in Europe.
Sure. So as a starting point, I think an important perspective is to comment on where we are and what we're all facing, because I think that the challenges that are faced on both sides of the Atlantic are essentially the same ones, which, as the other speakers have alluded to, there's been an obvious decline in equity markets. There's been a lot of volatility across all markets this year, and it's hard to find an asset class that's up other than oil. And so the question is, what's happening from here? What does the future look like? Does volatility continue? Do equities decline? What happens? And while we don't know, and I don't pretend to know, I think the important thing to realize is it really is we're in another new paradigm. We've entered a new paradigm with COVID and monetary policy shifting to fiscal stimulation combined with monetary policy. Now we're in another new paradigm. And inflation has cropped up its head, starting in 2020, certainly a big spike this year. And the question that we have, and the reason that we think that right now is actually a really important time to consider alternatives in your portfolio, is where are equities going? Because most portfolios are concentrated in equities. That's the baseline. That's why alternatives are actually called alternatives. It's an alternative to an equity or a 60-40 portfolio. And the reason to consider diversification now, whether you're on this side of the Atlantic or the opposite, is that we don't know where equities are going to go. There could be another leg down that's just as big as what we've seen so far. In fact, most of all of the equity decline we've seen so far, when we attribute that performance, we see it all being attributed to just a change in discount rates. There hasn't even been factored in a change in equity earnings, forward-looking earnings. To the extent we see a growth slowdown, you could see another big leg down in equities. So we could be completely wrong, that might not happen, but I'm just saying that's a possibility. And so we are not taking a strong bet on that. We have near-term views, but we're not taking a strong bet on that. That's just one example of the kind of volatility we see out there right now, the potential volatility, the risk. And when you see risk that size, I think that's why there's increased interest this year in asking about what else can I invest in, because I don't trust equities. I don't know what's going to happen. Some people are talking about, well, maybe now's the time to buy. We would not agree with that. Maybe it is, but we wouldn't bet on that. And so I think to me that's a very important context, is that where we are at a point in time today is a very dangerous time for traditional portfolios. The pain might be, the bulk of the pain might be yet to come. We don't know. So anyway, I think that's the reason to consider. And then in terms of trends, I don't pretend to be an expert on portfolios on either side of the ocean, But what we have seen with our investors is, scaling up and down of their alternatives mix. We do a lot of portfolio analysis ourselves. We work with our institutional investors in a way that goes beyond just delivering the returns, but also doing portfolio analysis with them of their whole portfolio. And I'd have to agree, something like a 3% or 4% allocation to alternatives really doesn't have much impact. It's almost not worth the trouble of due diligence. And so it's a question of, what is the right allocation? I'm not exactly sure what that is, but it's probably, significantly higher than that to have impact. It has to be a meaningful investment to have impact on the portfolio.
Thank you. Now I'd like to open questions in the room. If you can, one of you stand up, say your name, what you do, and then just shoot your question. That would be brilliant. Otherwise, I will ask a volunteer. Let me find someone. Yes.
Thank you. My name is Amal. I'm a financial consultant, and I come from Morocco, from Casablanca. So let's talk about transparency in the sustainability. We're coming from a period where we have a financial statement with 200 pages, and now we've added an ESG in the report, so we come up with 300, sometimes 400. And then we have some companies that are sensible on the question, and they tell the story that they would like to tell. So is it a hard task for you to assess all of this? And that was my question. Thank you.
Thank you. Anyone want to take the question? I can explain what I understood. Tell me. The ESG rules and all the framework can be very complicated. You need to report lots of things. There's Article 8, Article 9, and so on and so forth. Is that hard for you on a day-to-day basis to incorporate that in your company, in your culture, in the way you invest, in your investment committee, and so on? Is that... Nico?
Yes, so this is precisely the reason why we struggled that much to came down to one figure. Because it's nice, it's nice to have many figures and many reports, but at the end of the day, data, in my view, need to be some kind of related to decision. So a data without decision, you end up with a wealth of data which you just don't know what to do with. And so I had to, in the different discussion I had with partners, maybe fight is maybe too strong, argue, let's say, that we should, okay, you have E, and let's say 20 measures of E, 20 measures of S, 20 measures of G, and then the combination of both being 20 at the power of 3, and then after the temperature contribution, and at the end of the day, you're just stuck like Gulliver, in small ties. You just don't know what to do. So the discussion at the end of the day should be practical. Is that investment suited to what our board want to do or not? And you have to come down to something which is related to a decision-making measure. And this is, in our review, where the discussion should focus on after that wealth of data, which is extremely difficult to gather, and you have all the issues of divergence between the Sustainalytics, MSCI, and other providers of the world, which for one single company has a sheer dispersion of ratings. You have that issue, but another issue which is as serious is, at the end of the day, what you do.
As a matter of fact, at Amundi Alternatives and formerly LIXO, we haven't come to the point when we produce those reports. For a simple reason is that, as Nico just said, those methodology, taxonomy, whatever you call them, are designed for long-only security-based strategies. At the minute, you run a hedge fund, which is long, short, leverage, using a lot of derivatives and multiple instruments. Then you end up into a multidimensional matrix, ending up with very complex solution. And so far, we haven't found a solution, as a matter of fact. It's actually the only one. There are multiple depending on the strategy, the style, the geography, the instruments. So that's why you haven't seen many ESG, truly ESG hedge funds out there, because there's a barrier to entry. The only thing I would say, though, is it's not a fad. For once, this is not a fad, in my opinion. There have been many fads in the hedge fund industry. You had permanent capital, 130-30. More recently, alternative risk premiums. That might be a little bit controversial here, but anyway. And then the ESG in hedge funds, it's not a fad. This will happen eventually, but there need to be rules applicable to what we do. Clear rules.
Thank you. Do you have any other question? We're going to bring you the mic in a minute.
Hi, thank you. Very interesting insights. I just wanted to get back to the point about the relatively low allocation to hedge funds by Northern European investors. What I've seen in a market that I cover in the Netherlands is that there was a very strong pressure, especially on pension funds, to reduce fees. And one of the things, the easiest ways to do this was to sell hedge funds because they were charging at the time, 2 and 20. And in many cases, we're not delivering the performance for 1, 2, 3 years rolling. Do you think that with, obviously we've seen a trend in, let's say, the ETF space where fees have come down significantly and diversification has become, quite cheap, 3, 4, 5 basis points for S&P or Euro Stoxx 50. Have you seen? Do you think that the pricing of especially the liquid alternatives is in line with what's reasonable, what clients want to pay? Can you give some comment on how pricing has developed, where you see it level out? Because obviously running a complex strategy, is much harder than basically tracking an index. So people certainly understand that. But could you just give some color on how you see fees in the liquid and/or non-liquid hedge fund space?
Sure. I can make a few comments from our perspective. I used to cover the Netherlands on behalf of Bridgewater, too, so I have some historical familiarity with the marketplace. You asked, do we think that the fees are in line with what people want to pay, and are they the right fees? Those are sort of two different questions. Probably not in line with what everyone wants to pay, because the lower the better. But we have not changed our fees, as an example. So through time, we have not. That doesn't mean that we haven't been asked to change our fees, and we haven't been pressured for discounts, and it doesn't mean, it also is the case that some investors, including in the Netherlands, have redeemed, as a result of these discussions. So that sort of thing does go on, and we continue to see questions and pressure. But I do think, and it's ultimately up to the investor to decide, is this a fair fee? What we try to focus on is what net of fee return are you getting, and then over what time frame do you want to evaluate it? For some people, 1, 2, or 3 years is the right time frame. We would argue that a much longer time frame is what you really need to evaluate a manager, that 1, 2, or 3 years tells you barely anything. Our track record goes back to about 1991. And so over that long time frame, you begin to get some information, but 1, 2, or 3 years is tough. But not every investor agrees with that. And ultimately, I think everybody at Bridgewater, including myself, strongly believes that each investor has to make the decision that's right for them. But what we advise investors to do is to understand deeply, what is that manager doing? What is their strategy? Do you believe in it? Ask all the probing questions. How long is the track record? How long has the team been together? How much of, how well do they understand? Test their understanding, on and on. And so, you have to do your due diligence. And then in some respect, you're making a decision. Is it worth the fee that I'm paying? And each investor has to make that. So while we have seen fees decline, we've seen it in the industry, we haven't cut our fees.
Just a word, most investors I know, they are ready to pay huge fees when they identify a stream of return they want, and they identify it as really value creating. And most investors I know, they don't want to pay for something that doesn't bring them any value. So at the end of the day, it's just a matter of what you value for money. So if you feel that such investment is too close to an index, why paying more than an index fee? But on the opposite side of the spectrum, you have strategies which deliver very high return with very low liquidity generally. And here, investors are ready to pay very high fees, which is just obvious when you think about it.
Maybe last question, yeah.
Thank you very much. My name is Jeremy Touboul. I'm the co-founder of Liord Global Partners. It's a global macro fund integrating ESG into the investment process. My question to you is, you've been talking a lot about capacity, and you and I, we are limited in terms of capacity in this type of industry. This is very concentrated. And what is your solution in order to avoid this capacity constraint?
So you're talking about the ability to trade in markets.
We all know that by passing a certain threshold in terms of asset under management, when you are liquid alternative, it's becoming much more complicated to generate steady performance. So what is your solution?
We manage
what do you want to exceed capacity in the first place? If you believe if it's limited, it's limited.
Yeah, but you want to grow the business. When you are a Bridgewater, when you are a Boussard, Gavaudan, you want to grow your asset under management. You are expecting as well the market to allocate more towards alternative. So what's the solution? What do you expect?
So we limit our capacity. So I mentioned earlier, we're closed. We've given back profits in the past, and so what we do, we very specifically set up our risk budget. We know what markets we're trading. We have a risk allocation to each one, and we have limits, internal limits on how much we're willing to trade. We also have a dedicated trading group that focuses on trading analytics, because it's important to manage those transaction costs. Because what is capacity? It's really when your transaction costs become intolerable relative to generating the results you want to generate. Then that's where your capacity is limited. And so that's why we're closed, and that's how we manage it. It's just we trade 200 different markets, and so we have a small slice in each one, and we just manage our size, carefully, and we monitor it extraordinarily carefully. We gave back profits, years ago. We may have to do that again at some point, but it isn't important. It's crucial not to. What we don't do is compromise our risk budget. So what we don't do is just say, oh, we'll trade more of the more liquid stuff and we'll cut back the things that are less liquid, because we don't think that's what people invested in. So we don't change our investment approach, but instead we just close when we get too big.
Maybe if I may add something, you probably have made a promise to investors that your capacity for that strategy is X. And it will be difficult to deviate from that. Otherwise, investors will tell you, oh, you look at the performance, now they are deteriorating because you've exceeded what you promised to us. One potential solution is simply to launch new strategies, leveraging on your technology, your research, new instruments. That's one route. The other route you could expand is potentially, you said it shouldn't be a good idea, but trading usually is a limitation. Adding new markets, investing in trading technology to have less impact in the market when you trade. Those are the two things that we see generally, going through due diligence with managers. But we as an investor, we always are very vigilant with managers who say, okay, oh, by the way, I reopened, I'm going to raise another $1 billion. I say, why? You said it's going to be $2 billion. Yeah, but now, you know what, the market is supportive, blah, blah, blah. Usually, this is when the managers, move to a asset gathering mode, which in the end has an impact on performance. So this is generally not a good sign when you're an investor.
I'm just watching the time, and I think it's time for us to have a break and a nice drink together. We're still around. The panelists are still around, so if you have any questions, please come to talk to them. And I'd like to thank you, the panelists, very much and warmly for your time today and all the preparation and the discussion. It's very inspiring and enlightening, so thanks very much for your help. And thank you all for listening to us. Thank you.